We're speaking with Gerald Celente the day before jobs numbers, and he's not a fan of the U.S. economy. He joins us now. Gerald, thanks for speaking with us.
Thanks for having me, Daniela.
Gerald, let's start with job numbers coming out tomorrow. How closely will you be watching those figures?
The numbers will move the market one way or another. But let's not forget, when lousy job numbers came out the last time, I believe they came out on a Good Friday. I guess it wasn't a great Friday for the people that were unemployed, and they were about half of what they were supposed to be. And then the markets, the markets were closed on Good Friday. So you didn't see much of a hit to the equity markets when they finally opened up. And so the same thing could happen now as well, in the sense that the numbers are only going to be a temporary move. Because here's the real fact. You still have a labor force participation rate that's at 36-year lows. The jobs that are being created stink. We see the numbers and we see where they come from. And then you have all the people that they no longer count, that's bringing it also to a record high. So any kind of jobs that they're going to create aren't going to really create the economy that we need to have for growth.
Gerald, and on that note, is the fact that we've seen this mixed bag of economic data the reason the Fed hasn't given a more concrete clue as to when we could see a rate hike?
Absolutely. That's the only reason. I want to read you something very interesting. This is Bill Gates a couple of days ago. Low rates pose leverage and bubble risks. It's globally so unusual, it really shouldn't persist. It creates problems in terms of leverage and bubbles. This is Bill Gates. So, of course, when Bill Gates says something, everybody listens. It's only the low interest rates that are keeping the equity markets alive worldwide. You saw China lower its reserve rates. You see it everywhere with the negative interest rates, negative bond yields. It's the only thing propelling the markets.
Well, in April, we saw U.S. equities hurting badly, but in May, they've since recovered. Have you changed your stance on U.S. equities, or are you still bearish?
Yeah, of course I am. I'm bearish on all of the world equities because, look, every time they hint that rates are going to go up, the equity markets go into cardiac arrest. Everyone knows the deal. It is no secret. And it's like what even Bill Gates is waking up to it. It's the people buying back their stocks, these huge companies borrowing money for nothing, and then buying back their stocks and driving the price up. And the other one is the merger and acquisition activity. Again, borrowing money for virtually nothing and gambling with it. So, of course, I'm negative in the equity markets.
But you are bullish, or were bullish, on gold, calling for $2,000 gold possibly this year. Are you sticking to that?
Well, I'm a long-term investor. I'm not a trader in gold. And it may not be this year, but again, what I'm saying is when these equity markets tumble, there's going to be the reality's going to set back in. And gold is going to be seen again as that ultimate safe haven. So if I were to put a number on gold, I would say well above 2,000. Because even when it hit its height back in 2011, it still didn't adjust for inflation, considering what the height was back in the 1980s. So I see gold as really the only way to go. Why would I want to be in Bitcoins, another digital currency? Why would I want to be in the yuan when they're pumping money into it and making it easier for people to buy homes to keep the bubble up? Why would I want a euro when I know that they're going to have at least 16 months of quantitative easing?
And I know you're eyeing the situation in the Middle East as a catalyst to move gold prices higher.
Because the Middle East is on the cusp of another major explosion. Look what's going on. Every day you pick up the paper. And now you're looking at a new one with Yemen. And this is a big one that's under the radar. There is a possibility of an event happening in Saudi Arabia that could attack the monarchy and the oil fields that could further destabilize this already terribly destabilized region and cause the kind of financial panic that could really undermine the Ponzi scheme that they call the equity markets.
All right, Gerald, that's all the time we have today. Thanks so much for joining us.
Thank you very much for having me. All the best.
And thanks for watching this edition of Kitco News. We'll see you tomorrow.